Research with j.p.morgan. James, good morning. Thank you for joining us. James, is there merit in believing that most of the central bankers are now likely to cut rates, and that will ensure that money will remain abundant for emerging markets and for markets like India?
I thank you very much for having me on the program. I think you've hit upon one of the critical pillars that underlies our overweight recommendation on India. We just upgraded the Indian market within a global emerging market platform in March. The argument here is that the US Federal Reserve is starting to think about the rate cycle very differently. Instead of looking at an inflation target of 2%, they're moving to a different philosophy whereby they're looking for an inflation average of 2%. The implication there is that they're willing to accept inflation above 2% for an extended period of time as insurance against a future downturn. The way that the Fed accomplishes that is they leave rates lower for longer. It gives central banks globally significantly more runway to deal with their own domestic concerns. We've seen that at play within the RBI. We're now penciling in a 25 basis point rate cut in both the April as well as the June meeting, which is a significantly looser monetary environment than we had then expected several months back.
James, have to talk about morning firstly, what transpired across global bond markets. Do you really fear, even though Janet Yellen has completely rubbished all the concerns with regards to a US recession, but now with the yields actually inverting, do you sense that US could grapple with an issue later? Maybe not a recession, but a slowdown for sure.
I don't think a slowdown is precedented. What we've seen in this overall macro cycle that's been at play for the last 10 plus years now are multiple cycle resets, where you've seen a period of slowdown, you've effectively reset and allowed the cycle to continue. I would not be surprised at all if that continued. The implication for emerging markets, however, I think is varied depending on the market that you're looking at. For the Indian market in particular, we're looking at two very compelling pieces of evidence that drive our overweight recommendation. Number one, the negative earnings revision cycle that we found ourselves in for most of last year has started to stabilize. We're looking at significantly better earnings revision breadth, with only 13% of Indian companies seeing significant negative revisions over the course of the past quarter. It's a very different environment than what we've seen from last year. You pair that with very, very light investor positioning. In our survey of global emerging market fund managers, positioning in India is currently the lightest that it's been since September 2012. So you start to look at stabilization of earnings compared with very, very light investor positioning. We think it sets the stage for some pretty good market performance moving forward.
James, in the report, you've spoken a little bit more about where we've seen pain when it comes to earnings, where we've seen stability. Given the fact that, you had weak earnings from the financial sector, you had the IT sector, which recorded flat earnings, healthcare as well saw some downward revisions. Can you just elaborate a little bit on these three sectors? What is the earnings picture now?
So we are seeing an improvement across those sectors. In the financial space, we are overweight financials on the argument that they'll be prime beneficiaries of government expenditures, particularly in the infrastructure space. The other key thematics that we're very interested in is the urban consumption trend. And we have a series of stocks that we're looking at within that bucket. And then from an IT services perspective, from an exporter's perspective, we are favoring IT services over healthcare at this stage. And again, the storyline is not necessarily massive positive revisions. It's really a stabilization of the negative trend that we've seen over the course of the past 12 months. And we're really seeing that on a cross-sector basis right now.
James, if a client walks up to you and he says, James, give me a 3-year trade. Here's my $10 million. I will ask you only after 3 years, and you're going to double me. You're going to double my money. So no question asked, take a free check, after 3 years, double my money. Which is that one asset class, one country, or one instrument you'll buy?
So I would have front and center with the conversation. One of the consistent things that we've heard when we hold our India summit in Delhi every year is a parade of government ministers talking about the very, very significant and at times radical public policy experiments that we see at play within the Indian market. What was clear from our Indian summit last fall was that a lot of these experiments have begun. Some of the pain has been taken, but the positive impacts have yet to flow through. And that's everything from Aadhaar through to the implementation of the GST, which we think will significantly boost long-term productivity and therefore economic growth for India. What we're seeing in many instances is a radical restructuring and transformation of the Indian economy in a way that we just have not seen historically. So I think we have to be structurally bullish on India. The demographic trends are undeniable, with over 60% of the population sitting below the age of 30. That's one of the most favorable demographic profiles that we have in all of Asia, and contrasts very severely against the aging of the population base that we see in other emerging markets, particularly China.
James, the India earnings or the romance or India romance is largely centered around consumption. It is not manufacturing. It is certainly not, what's happening to, it is certainly not metals or resource. Now, Indian consumption stocks are expensive. So these sectors will continue to grow. But if you buy Indian consumer stocks, whether it is discretionary or staples or durables, it's like saying that I'm buying gold, silver at the price of gold. So how does one really justify the rich valuations here?
I think you have to look at two different matrices. Number one, what is the future growth prospect that you're purchasing? And so trading Indian consumers on a steady state valuation basis relative to other markets will always by definition be misleading. One of the key things that we've always looked at on a cross market perspective is the fact that comparing PE multiples in one market versus another by definition will lead us down the wrong path, because you're looking at significantly different growth prospects across two countries. If I look at the overall GDP growth rate of the Indian economy, even relative to the traditional powerhouse of China, there's clearly a very positive story to tell there. Secondly, as we just stated, I also think we have to look very, very closely at the restructuring that we're seeing across large elements of the Indian economy. And you make an incredibly important point. If the backdrop to this conversation is a potential slowing of the global economy, potential weakness in the US, particularly as we roll into the second half of 2019, first half of 2020, what we want to look for is an economy that is far more domestic demand driven than manufacturing and exporting focused. And we feel India fits that bill quite nicely.
Given the fact that, James, we're seeing crude oil prices as well inch up, are you seeing some pressure building up then for India?
It's a great question. Important to put the oil price into perspective. What we're looking at is a 35% bounce, but that bounce is off of very extreme lows that we saw towards the tail end of last year. If we look at it on a through the cycle basis, oil sitting in the mid 60s is not that troublesome for the overall Indian economy. On a commodities future look perspective, we are looking at relatively range-bound oil for the course of the next couple of years, particularly as the global economy continues to slow. So we don't see oil as a primary concern. It is something that we are watching very closely, however.
Right. James, a large part of the rally, besides, of course, consumption, which is the main lead of the India romance story, so to speak, has also been financials. A large part of the index, almost 30 to 40 odd percent. And even if I just look at the March rally, which is played out in India, that's largely been driven by banks within financials as well. Do you believe that financials will continue to remain at the fore of the India story as well?
We do, and there's a couple of statistics that I'd point to in that vein. Number one, we obviously have the loan growth statistics, which continue to be quite strong. We just got the best deposit growth statistic that we've seen in over 19 months, which is usually a precursor of future economic growth. So we do remain quite positive from that perspective. And from an overarching perspective, again, as we just stated, we are seeing very strong financials performance as they are levered into a lot of the government infrastructure and mega project spend that we expect over the course of the next couple of years. So we remain overweight financials and are very comfortable with the outlook for that sector.
What's the expectation then when it comes to the overall monetary policy? How do you expect the Reserve Bank now to react in the upcoming policy meets in April and June?
So it's statements out of the RBI. They have moved from a tightening to more of a neutral stance. Again, we got the 25 basis point rate cut in February. Our economists have penciled in an additional 2 25 basis point rate cuts in the next two meetings in April and June. The backdrop to that conversation, though, that I feel is extremely important, and we do spend a lot of time discussing with investors, is this change of philosophy that we see occurring within the Fed. The movement towards inflation averaging is an incredibly important theoretical construct in that it forces the Fed to try to readjust long-term inflation expectations higher. How do they do that? They leave rates lower for longer, give significantly more breathing room to global central banks.
Okay. You know, as part of what we've seen within the auto space as a whole, auto sales have been coming in rather weak. What exactly is the outlook going forward? Because we have a lot of analysts which have been, you know, turning fairly circumspect on the sector. The slowdown in two-wheelers as well is becoming a bit of a concern. In light of the current macroeconomic backdrop, what's your take on auto?
So clearly within the broader consumption space, auto has been the weakest component. At the moment, we're far more focused on the urban consumption theme, and therefore not necessarily directly looking at the auto stocks as overweights within the broader portfolio. And we would rather look elsewhere within the consumption bracket. We will see how this plays out over time, however. If economic growth continues to be quite strong, then big ticket purchases can clearly come back. We haven't seen that in the data yet, however.
James, with the rupee now appreciating vis-a-vis the US dollar, would you get a little circumspect about the prospects of IT and pharmaceuticals going forward?
It's clearly an incremental risk factor. If we continue forward with our economic forecasts of rate cuts ahead of pace that we're seeing across a lot of the rest of the global emerging markets, we do see the rupee overall range bound over the course of the next 12 months rather than a fundamental strengthening trend, which would really require a significantly more aggressive backdrop, either in terms of rate hikes or the RBI to hold pat. Again, we do have subsequent rate hikes, rate cuts penciled in for the next couple of meetings.
You know, we've also been focusing over the past few days actually on what's happening within the utilities and the power space, and there is a consensus call that with the lower interest rate environment there is a chance or a prospect for growth within the space. Given that there's been an earnings downgrade, you know, within the sector as a whole, are you seeing signs of a revival? Are you seeing signs of a potential uptick here?
So it's in looking at the relationship between earnings downgrades and then the forward-looking expectation. One of the things that is potentially counterintuitive for some, the more aggressive the earnings downgrade cycle, the lower the bar you are setting for future growth. And so one of the things that we do screen on across regional portfolios as well as the portfolio in India are sectors where expectations have become overly bearish because of a series of concerns. And I think you very rightly point out, what we've seen are significant earnings downgrades across almost all sectors in India over the course of the past 12 months. For the Indian market as a whole, that is starting to stabilize. At a subsector level, we are finally starting to see strength. Again, the key statistic that I would point to there is the breadth of revisions. Only 13% of Indian corporates are now seeing significant negative earnings revisions. And so it is a very broad-based strength across the broader Indian market.
James, how critical to your India view is the upcoming elections, and would you say that it's imperative that the current administration comes back to power for this kind of bullish call to persist?
There are far better people than I to forecast the outcome of Indian elections. What I will say, on a personal basis, I have been impressed with the public policy experiments that we've seen out of this government. GST is a great example where you're creating a unified export market across the Indian continent, really for the first time in the history of the country. That is a very, very significant development in terms of overall productivity trends within the Indian economy. And so these public policy experiments, I think, have been large. They have been at scale. Some have gone well. Some have had some teething issues as they've been implemented, but they're clearly not wanting for imagination.
Yeah, indeed. Okay, James, great to have you on the show. Thanks so much for taking the time out and speaking with us today.
Thank you.
That's The View then.